as we get started today, first, let me go ahead and introduce myself. My name is Austin Bransgrove. I'm on the team here at Rethink Wealth. Rethink Wealth is based out of Texas. We've got offices across the state, a couple up here in North Texas where I am, San Antonio, Houston, Austin, and we work with clients all over the country. We're part of the Guardian Network, and we go through and we specialize in supporting business owners in how they understand their business as an asset and how they understand how to mitigate and manage some of those tax impacts that affect their ability to build wealth. And that's what we're going to go through and be talking about today. So as we look and review the slides today and review this concept of an MSO, there's going to be a number of times where you're going to see this QR code pop up. And as that happens, my invitation for you is if you say, hey, this would be really interesting, I need to go through and explore what this looks like, take a moment to pull out your phone, scan that QR code. It'll take you right to the calendar and you can book a complimentary business owner consultation, just an initial meeting there. Then we can start to unpack specifics to your situation together. On the webinar here this morning, you also have a Q&A that is available. So if there's questions that are coming up for you, we've got that Q&A feature enabled. Go ahead and feel free to type those in. We would love to be able to address and answer anything that's coming up for you as we're looking at this together. We've been using this technique as one of many to support our business owner clients, especially physicians and dentists, in how they're managing their taxes, as well as addressing some liability issues, debt repayment, things like that, much more that we're going to get into together today. So without further ado, let's roll up our sleeves and dive in. When we first get to meet new clients, what we often find is that their world looks something like this, where they own a business, perhaps they own some investment real estate, and their income is derived from W-2 wages coming out of their company, as well as K-1 dividends, distributions coming out of the real estate, coming out of S corporations, so forth and so on. And what happens is before any of those dollars can be put to work for additional wealth building or used for personal expenses, the IRS wants their pound of flesh. And as we talk today, I want you to think about how many days a week are you working for yourself and how many days a week right now are you working to pay the IRS? How much of your money goes to the IRS? So those taxes go out, and whether they're from money that you're investing or just the business earnings, whether you are repaying debt or not, those personal taxes have this increasing kind of compounding effect. And so what happens is as you have more financial success, as you earn more, as your distributions out of the business become higher, as you have real estate that's more profitable, that compound growth of income, it doesn't just lead to more tax because you made more money. It can actually lead to higher and higher tax rates as you make more money. And you end up with this ballooning tax situation, especially with the big, beautiful bill that was signed on the 4th of July. There's a few phase out provisions around state and local income tax deduction limits, QBI, which is under Section 199A that we've had for a while, where if you pass a certain threshold, you start to go through these phase outs and your marginal tax increases can be enormous. Not like 30, 35%, talking 60 to 100% kind of increases in some situations that we've seen. And so as your income grows, you're building wealth on your balance sheet, and often that wealth building leads to more tax. Because apart from retirement plans and a few like very niche strategies that some of our more successful clients will already have as they come to us, what you have is compound growth, growing income, leading to compound tax, even when personal expenses aren't that high. And it's not that uncommon. We'll work with folks making well over $1 million a year that's showing up as income on their tax return, but their expenses are a fraction of that they use for lifestyle and household and their quality of life. And so much of what they earn is going straight to the IRS, or they're reinvesting into the business, or building these accounts on their balance sheet. And so the question that we look at it from a financial planning standpoint is, well, how can we evaluate structurally a change that will accomplish a few really important things, especially how can we make this tax situation more efficient? And so the idea we're going to talk about today is this idea of a management service organization. This type of company has been around for a really long time. It's been used for years and years, decades, in structures where you have private equity funded roll-ups of different medical practices, urgent cares, dental offices, hospitals, et cetera. The medical industry, I think, sort of invented this thing. And the basic way it works when you think about it as a person, as an owner, is that you end up with two companies. So right now you probably have one, maybe you have a couple if you have some real estate, or you have multiple locations. Maybe you're a dentist, a veterinarian, maybe you're a physician, you own some urgent cares. We've got clients across the spectrum that have all of those situations. And each of those locations, each of the real estate is a different entity. So you have these pass-through businesses. You're the 100% owner of these pass-through businesses. And the idea here is that you have certain functions that touch all of the business, right? There's this just operating the enterprise that has to occur. And so that's really where this function of a management service organization comes. And we're going to flesh that out. We're going to add some more color to that picture as we talk more today. But essentially, you have your operating businesses pay this separate entity that you also own for these operational services in your business, and that operational services then is what's provided for that fee. Okay, you can't just make the fee up. There's got to be a very methodical process of determining what that fee is, because if you own both businesses and you just sort of make numbers up, that's very easy for the IRS to challenge. If you go through this properly, the strategy really isn't a lot to write home about from an audit perspective, an audit risk perspective. And where we begin in crafting, does this strategy make sense, is these 4 bullet points on the right. And as I go through these, I just want to reinforce, we've had some people hopping on the call here as I've been starting. That QR code leads directly to my calendar. So if you are having some questions, you want to see how this may look in your own world, my invitation to you is go ahead and take the opportunity to scan that QR code with your phone. It'll take you to my calendar. You can block out 45 minutes to an hour for us to go through and just talk about what's going on in your world, what questions you have, and see how we may be able to support you. So I saw a wonderful post from a tax attorney a few weeks ago. And she said, if it works for business purposes, you can make it work for tax purposes. And I think that's the helpful framework for how you want to start this strategy. If all we try to do is say, oh, well, we're going to create a company, but it's not going to really do anything, and we're going to try to save on taxes because it's a different company, again, that's really easy for the IRS to challenge. The IRS has this doctrine, you can't form a business only to reduce taxes. It has to also have a business purpose. And so let's start with that business purpose. First and foremost, the top item we see our clients looking to accomplish as we think about adding in an entity to your overall structure is structural and operational integrity. Very frequently, when we're talking with our clients who own multiple different businesses, different real estate entities, managing all of that is the job of a couple of specific people in their world. And so they've got some employees whose job really is to keep everything going, keep the machine running, so to speak. that need for centralization, you think about it at a huge scale with these private equity funded deals. I mentioned these roll-ups, these conglomerates in medicine and dentistry and the veterinary space. They all do this too, where they've got the operation of the enterprise handled in this separate entity, and each location that's seeing and treating patients and doing this work, that's its own entity. Okay. So you end up with a way of doing things that just makes sense from a business structure perspective. It's much easier to manage. You have clear delineation of roles and responsibilities. And it ties very well into the second bullet point of asset protection. With asset protection, the idea that most of our clients start with is that you have separate entities for each of these different components of your operation. I've said that a few times. I want to draw attention to it. Usually, I'll see each investment property or commercial property, it's often owned in its own LLC. Each location, if you've got different dental offices, veterinary offices, even if you have different operating businesses. A few weeks ago, we were speaking with a client who owns multiple different companies. There's 3 completely separate companies that operate, and they operate in 14 different states, and they're totally different industries, what these 3 companies do. And the reason that there's these 3 different companies for this client, or these multiple like per location LLCs or PLLCs or professional corporations for medical practices, dental practices, and so forth, is to try to get asset protection, right? I'm sure that you asked, and at some point, an attorney or an accountant or a financial planner like myself said to you, well, we should have a separate company so that you have asset protection, okay? And that asset protection is designed to be like this watertight door on the ship that you see in front of you. The purpose of it is when you're going through any kind of situation at sea that is potentially dangerous, right? You think about the Navy, right? If they're in a battle situation, all of these doors are going to be shut. We've got a guy on our team who helps run our office in San Antonio who served in the Navy. He and I were talking about this, and he said, "Yeah, man, like every time that we go through and we were doing drills for combat situation and preparedness, or we were in an actual combat environment, every single one of these doors would be shut. You'd never see them open like this unless you're kind of like at a dock." And the reason why is because you don't know when that threat's going to come. But when it comes, that watertight door is supposed to isolate the damage. The same is true for your balance sheet. This LLC wrapper around each of those investment properties, it's supposed to isolate the liability. So what touches one area doesn't cascade across your balance sheet. The same with your operating businesses. What touches one business is not supposed to cascade across all of the others. And you have to have it done in advance because you never know when that threat is going to arrive. It could be a very simple moment that is just unforeseen, right? You could do nothing wrong, but your employee crashes a company truck, runs over, crashes into a bus of kids or something, right? Like that moment, even if it's a total accident, now you've got a liability threat. And so what I find is that most owners don't have very good watertight doors. Most owners have leaks, and there's 2 primary places that these leaks come from. One is an error of formation, where it just wasn't done correctly. The documents themselves weren't drafted in a manner that was protective, or the attorneys who did them chose to use a structure that wasn't as protective for liability as it otherwise could be, okay? That's pretty rare. That kind of mistake doesn't often occur. What's most common in our practice that we see is that a business owner will have an error of operation. What does that look like? Well, it looks like you've got different businesses operating across 14 different states, and you have 3 people who are key members of your team helping make everything run, and they touch every single one of your businesses. They have purview and manage some kind of operations around every single one of your investment properties, right? This is real life. I saw this just a couple of weeks ago. But those three key individuals, they receive a paycheck out of one company A of these three totally distinct and separate businesses. Well, if there's a lawsuit, what happens is assuming that the business owner loses, then what happens is their attorney, if they're worth the plaintiff's attorney, they're worth their salt. They're going to go to the judge and say, Judge, this business owner, they have this employee and they don't treat them as if like all these businesses are separate. This employee does the same job for all of these companies, and there's no invoices back and forth. They're not getting paychecks from different companies. They treat them all as one business because they have these three individuals who are just doing everything for all of them. They're not owners, they're just employees. Like, why should I have to treat it as separate businesses if the defendant doesn't treat it as separate businesses? And that's a pretty strong argument. And what can happen is that you don't have a watertight door, you have the Titanic. And so many people that we see, when they own multiple different practices, multiple pieces of real estate, they may not be as protected as they think they are. And as I'm saying that, if you're thinking to yourself, oh my gosh, this is me. I've got 2 locations. I've got 3 businesses. I've got these different real estate investment properties. Scan the QR code. Let's set up a time to talk. Okay. This is absolutely one of those check marks that we go through and we're evaluating. Do some planning conversations need to occur? If you're saying to yourself, this is me, like I feel like Austin knows me, even though we've never talked, scan the QR code. Let's make time to actually get to know each other and see how we may be able to support you with some modifications here, because that's the first box. That's the second bullet point here, I should say, in terms of looking at, does this make sense? And what happens is we move all of those areas of overlap across all of these different businesses into the MSO, right? And it isolates out your exposure to that kind of liability, this error of operation in your business, because you're going to start treating them as individual, distinct, solely independent businesses, right? You need something done from one business to another business. You've got a management company that is contracted by your operating businesses to go through and provide those services. No problem. And it allows you to increase and retain far more sufficient asset protection than most people usually have when we first start to take a look at this. The third bullet point as we're examining this is about purchasing power and debt service. And as we talk through this purchasing power and debt service, I want to distinguish between pass-through businesses, S corporations, partnerships, disregarded entities, and C corporations. Most of the time, as we look at setting up these MSOs for clients, what tends to make sense is we use a C corporation for some tax diversification. We want some tax rate choices. As it stands, 98% of the clients that we see, every company they own passes through this column on the left here, this S corporation partnership. And most of the people that we're working with, where this type of strategy makes sense, you're at the top federal tax rate. You're paying 37%. You're also generally paying 3.8% on those K1 distributions with net investment income tax. And so the pre-tax income required to net $1 in after-tax profit is $1.69. $1.69, you assess that 40.8% tax, nets you out $1. In a C corporation, there's a flat 21% tax. Okay? So almost half the tax. And what happens, half the tax rate, I should say. What happens is it only takes $1.27 of profit inside a C corporation to net out $1. Why does this matter for purchasing power and debt service? You may be saying to yourself, Austin hasn't talked to me about how interest is deductible. And you're right, I haven't. Interest is deductible. But debt repayment is always a combination of interest, that's deductible, and principal repayment, which is not deductible. And the real cost of debt is not the interest rate that you pay. It's the taxes you will owe to repay the principal. I'll show you what I mean. When you have the same situation, both sides, right? We're imagining an S corporation alongside a C corporation. What happens? There's $1 million of debt for real estate, $500,000 of debt for equipment and machinery, and you can replace those categories with anything else. I've seen $2 or $3 million on equipment and no real estate at all. I've seen only real estate. This really can be interchangeable with what the line items are. But we're looking at a total of principal owed to the bank of $1.5 million. In a pass-through business, in your S corporation, it's going to take $1.69 of earnings for every dollar of debt that you have to repay at those top tax rates, which means you have to earn profit out of your business after all of the other expenses, after you've paid your staff, after you've done the benefits, after you've paid all of your other vendors, everybody else, you have to have $2.5 million of pre-tax income to go through and pay the income tax of over $1 million to repay that $1.5 million. And you don't see it in this big a chunk because what happens is you're paying the $1.5 million back over years, 10 years, 15, maybe 20 if it's real estate. And so you don't see the inefficiency. It's not immediately apparent, but this is what's happening. And the IRS is going to receive nearly the same amount that the bank lent you just because of the tax inefficiency of this transaction. In a C corporation, because the tax rate is lower, it's only a 21% rate. It only requires $1.27 of profit inside a C corporation to repay the same amount of debt. It costs $1.9 million of net profit in the C corporation, that net income, to go through and pay the debt. And what happens is this comparison, you have $630,000 less money that goes to the IRS, $630,000 more money that stays in your economic world, a cost savings of 42%. Most of the business owners that I know would bend over backwards. Like they would move mountains to save 1.5%, 2% of interest on the debt servicing for $1 million, a $1.5 million loan. This is dramatically more impactful. 42% cost reduction just by structuring it differently. Again, I ask you to think about how many days a week are you working for the IRS? How many days a week are you working for yourself? Okay. And so that brings us through, and I've got that QR code up again, right? You may be thinking, oh my gosh, I've got a lot of business debt. And I've seen it. Every year we see businesses that have all kinds of manners of debt. Just this summer, we're working with a company that had $15 million of debt. Okay. Now they make a lot of money. They can afford to service that. That's all great. But imagine the tax inefficiency here. $15 million of debt, 42% tax inefficiency happening on their balance sheet. When we stack all of these things up, it brings us to the last bullet point on the screen, right? My QR code's here again. You can go through, schedule. If you're just identifying, man, I've got this, I've got this, I've got this. The invitation here is let's schedule some time to talk about what this means for you. This tax efficiency piece is really about the profit that you keep, okay? In a pass-through business, that top rate is a little over 40%. In a C corporation, it's 21. And so depending on whether you have exposure to net investment income tax or not, you're talking about this top marginal rate savings of nearly 20%. And this is on top of some additional updates that are especially poignant given the tax law that we received on the 4th of July earlier this year. You see, there's this provision that's been in the tax code for quite some time called Section 199A. And it's the QBI deduction Essentially, what it allows you to do is up to certain limits, you can deduct 20% of your business income off of your taxable income in a pass-through business. So think your K1 distributions. That's really the dollars that apply here, K1 distributions. And the key that this has been a hang-up and inaccessible for many people that we see is that there are specified service trade or service or trade businesses. SSTB is the IRS's acronym for this, where if you earn over, this year it's like 383,000, next year it's 394,600 for a married couple filing joint. If you earn over those amounts, you don't have the full access to the deduction, and eventually it phases out completely. But underneath that amount, and I find even for some of our highest earning clients or wealthiest clients, many of them are spending $22,000 a month, right, at the top end on what it takes to have living lifestyle. And everything else they're saving, they're investing, they're going for the future. And so what we see is that they would pick up all of this efficiency if their income was low enough, but they're just too financially successful. Their businesses are too profitable. And so they don't receive that QBI deduction because they're not making $380,000. They're making $800,000 or $1.5 million or $2 million. And eligibility for that QBI opportunity is gone. The other opportunity that came, and this is, I should add, that QBI deduction was supposed to end initially. The original law is that it was going to end at the end of 2025. So for a long time, this wasn't necessarily the biggest planning point as we were thinking through this because it was so temporary. Especially as we were implementing these strategies for clients earlier this year, the end of last year, we maybe got a year out of it if we could use that QBI provision. But that provision has been made permanent under the big beautiful bill. So think through, well, what do I need to live on? If it's 20 grand a month, 25 grand a month, like we really should be having a conversation to explore how can we pick up eligibility for that provision. If that's all you need to live on, you don't need $800,000 to live on. Maybe there's an opportunity here. The second opportunity is state and local income taxes. For years now, since 2018, we've had this $10,000 cap on state and local income tax. And many states have implemented. You may be saying, well, my CPA has me pay taxes like a professional tax out of my C corp or my S corporation, and you're totally right. That's what a lot of workarounds have been to try to sort of make things right on a distribution side. But it doesn't do anything when you're talking about real estate or sales taxes or other types of state and local income tax beyond just that K1 side, that income tax side that you accountant may have you pay for it out of your S corporation. Well, the opportunity here is that now that state and local income tax cap is $40,000 unless your married filing jointly income is over $500,000. And if you're over $500,000, then there's a phase out up to $600,000. And at $600,000, you're back to 10. So it's like back to the same inefficiency that you had before. We were looking at this for a client just yesterday. And as we stacked up both QBI and the state and local income tax deductions, we examined that they were going to pick up 5 figures of income tax savings annually just by being able to gain eligibility for those provisions. Now, how do we do that? Well, we've got to figure out how do we have your income structured in a combination of these entities, both the pass-through business and the MSO, so that you're only paying personal income tax on what you consume, not on everything you earn. This is, again, where that MSO becomes so critical, so important, that we want it to pick up income because the MSO's net income doesn't affect your eligibility for SALT phase-outs. It doesn't affect your eligibility for QBI. And so if you're thinking to yourself, man, I don't spend $70,000 a month, even though my earnings are, over $1 million a year. I spend like $15,000 a month or $20,000 a month. Great. We should be having a conversation because these numbers here that are on the slide are the beginning. They're not the end. If we can go through and pick up eligibility for QBI under Section 199A, there's an additional thousands of dollars that can be saved with a 20% deduction. If we can pick up itemized deduction eligibility, if you're in a state where there's a lot of state and local income tax, property taxes, things like that you're showing on your personal tax returns, that you would be able to deduct if that $10,000 cap didn't exist, maybe it's possible to go through and pick up eligibility for state and local income tax deductions again on an itemized return, which could save you, again, 5 figures of tax on $40,000 of additional deductions that you just can't take today in the same way. And so stacking all of these things up, it's not merely the tax efficiency here, nearly $20,000 for every 100 grand that the MSO earns instead of it showing up on your own personal tax return. It's also these additional components that you add along the way. And for clients where this makes sense, we typically see 5 and 6 figure annual tax savings. Now, one of the questions that I get, and I do have the Q&A open, so if you're thinking through, man, I have this thing that I'd like to ask Austin, type it in the Q&A. I would love to answer it for you. One of the things that I hear and sometimes comes up is this myth of double tax. I once had a CPA in New York go through and say, well, you're wrong, and this is the double tax, and this is how it works. And I kid you not, he didn't correctly do the math. So let me show you what the math is. That way you don't run into the same kind of issue as you're trying to figure out, well, does this make sense for me? How does this work? In an S corporation and an LLC, those pass-through tax returns, every dollar goes to your personal tax world. So you earn $100 at that top rate, you keep $63. You paid $37 in taxes for the $100 of earnings. In a C corporation, that's not landing all the way on your personal tax return, you're paying a 21% tax. And so $100, you keep $79. That's that net income for the C corporation. And most of our clients keep those profits inside the C corporation for years because they're able to grow $79 in investments in real estate and business ventures and the like far more quickly than they're able to grow $63. You start out almost 20% better. So wealth just accumulates faster. But if you said, no, I'm going to take it all out the same year. Okay. Well, if you did that at the 20% tax rate for the net income on this, those dividend distributions, that's how it'd be taxed, you still have $63. It's exactly the same. There's no difference. If you didn't need all of it, and it was sort of a unexpected thing where, oh man, we had too much profit go to the C corporation, we need to take a little bit back, let's do it as a dividend. Well, if we could stay within that 15% dividend tax rate, which is a very high bracket to land inside, like well over $500,000, that now you have $67 and you're still 4% better off just because you went through and did this, right? I'll say this is the exception, taking money out that way. It's not typical. Most people, as they're accumulating wealth, they're leaving profit inside the C corporation because they want to go through and be able to pick up that asset protection, to pick up the improved purchasing power, debt service, to retain tax efficiency, so that you don't have compounding growth with investments in real estate and other income generating accounts, compounding a personal tax on your balance sheet the way that you do today. You may say to yourself at this point, right? What I said to myself the first time I started to learn how this works years and years ago is I said, man, well, what do you need? Like, where does this make sense? Who does this make sense for? Where is this just not going to work? Where's it a bad idea? And there's a few things that we need to help you answer that question. There's a couple of categories that I'll give you today that are just immediately, if this is your situation, this is not going to work. Okay. It doesn't work for everybody. We've got to find that out together. There's a few things that we need. And I'll ask you, take your phone out, scan that QR code. Let's set a time to talk and begin the process of gathering these documents listed on the top 3 bullet points. Number 1, client information sheet. When you go through and you book out a time to connect, what'll happen is a member of my team will make sure that you've got an information sheet just so you can jot down. It doesn't take long. It's like a 5 minutes or so to fill out, so that you can have some of those initial things handy that we're going to ask the first time we get together. Okay. If you're super comfortable, you want to send this stuff to us in advance, no problem. Happy to do so. A lot of times, the first time we meet with somebody, you want to get to know us a little bit first, and then you send us the documents. That's fine. Okay. The second thing I'm going to ask you to pull together is your last 2 years of personal and business tax returns. And given the time of year that it is, I'll ask you to also pull together your current year's results, just so we can see, if income's really lumpy and there's some years that are like amazing and some years that are really terrible. This may not be the most impactful situation, but we'll look at it. Okay. If income's really consistent and every year you're like, oh my gosh, I can't believe I'm making more money this year than I did last year. How's this work? We see that pretty often with a lot of our clients in the physician and dentist space, especially. Then, yeah, this kind of thing starts to make a lot of sense. And then lastly is a personal financial statement. You may have one handy if your bankers asked for that recently for some business loans, but we've got a template document that we can give you as well if you need a way to pull all of that together. Okay, so first things first, you need to kind of collect what's going on from a data standpoint. These important questions allow us to really start to say, maybe this makes sense, or no way this makes sense. Okay. None of these things are going to tell you 100% you should do this. We need a conversation to go through and figure that out. If you want to have that conversation and invite your accountant to join, no problem. Happy to go through and have them on. We're not CPAs. We've got teams that we work with that go through and have supported us with dozens and dozens and dozens of clients. But if you want to have that first discussion where it's us, you and your existing CPA, that's perfect. We would love to connect with you that way. Here's those questions. Number 1, how much money do you need to live on each month? And the way that I want you to think about this is that if you go through and you spend most of what's coming in as that profit landing in your world every single month, and even those distributions that you're taking out of your business on a regular basis, if that goes to lifestyle, we should not do this. You're going to hate it. If, however, you find that you're regularly saving outside of retirement plans, you're saving over $100,000 a year, and you're in that top 35 to 37% tax rate, this might make a lot of progress for you. So maybe we should do it if you're able to go through and have that kind of difference. This is also really helpful for us to understand. Maybe we have an opportunity with QBI deductions. Maybe we have an opportunity with state and local income tax phase outs if your monthly expenses are below a certain number here that the IRS gives us as those thresholds where the phase outs start to begin. If it's low enough, then yeah, we need to look at all kinds of ideas of how to get you eligible for those deductions again. Number 2, do you have any unreimbursed medical expenses? Normally, those are not deductible inside an S corporation or past partnership kind of tax status. Sometimes, often, they can be inside a C corporation. So if that's a meaningful number every single year, worth taking a look. It can kind of tilt the scales in one way or the other. Third, do you have any long-term care insurance premiums that you're paying for? I found more and more often, as we've had clients experience their parents or their grandparents needing a lot of healthcare as they were retired, that they're already starting to say, all right, we've got to get some planning done for this. They come to us, they've already bought long-term care insurance at some point. Great. Those premiums really aren't deductible very well inside an S corporation or a partnership. They can be 100% deductible inside a C corporation. So again, can tilt the scales in one way one direction or the other. And then these last two items are about after-tax expenses. Okay. If you've already bought life insurance or disability insurance, this also applies. Before, probably your agent said to you, your business can pay for it, but it's not deductible, right? That's normally that's pretty true. However, it's also often an option to pay those after-tax premiums through your C corporation. And there's different mechanisms that you can use to go through and do it. Sometimes there's ways of actually being able to have money come out of a C corporation that'll live in your balance sheet where you'll retain it. You'll have some access to it through loan regime split dollar techniques on life insurance. If you already have policies, you need to kind of sum up, well, what are those premiums that you're already paying? Okay. Sometimes you don't have them and it makes sense to add them, but look at what are those numbers already? Are you paying thousands of dollars a month for these policies? If so, again, that may tilt the scales in one way or another. And lastly, how much business debt do you owe? Remember, every $1 million that you owe, there's a 42% tax efficiency to be had if it's possible to restructure that debt into the C corporation, right? So $1 million, if it's possible to put all these pieces together, we could save $420,000 in taxes just by doing this. So is it an automatic? You have to go do this? No. Does it help us understand the weight of all of these pieces? Yes, it does. And the more items that you say yes to, the more pieces that tilt in your favor, the more probable it becomes that maybe this makes sense. And it's worth that conversation to explore together. Book that time on the calendar with the QR code that you see here. And again, would welcome the attendance of your accountant if they need to come. This is one of those things, guys, where this is a team sport. There's no CPA, financial planner, attorney who really is going to be able to execute on all of the pieces of putting an MSO together just by themselves. Okay, we don't do it by ourselves. No one else is going to do it by themselves either. And as you're thinking through those pieces, I'm going to do a pause here just for a moment in the sharing. I'm going to switch the screen just a little bit. And we got two questions that came in that I want to answer. Okay, so let me go ahead and do that. Take a moment. We've got a few minutes left. I always try to keep these within about 45 minutes or so. We've got a few minutes left to answer any questions. If there's anything coming up, go ahead and take advantage of the opportunity now to type that in the Q&A box, or even better, sometimes go ahead and scan that QR code and let's set a time to talk. First question I got is, you guys are in Texas. Yes, we are. And I'm located in Pennsylvania. Great. Just yesterday, talking with somebody in Pennsylvania. He says, are you able to work with us? Short answer is yes. We support and work with clients all over the country. We work really hard to go through and pick up relationships with professionals that can support clients in any state in the United States here. Got another question. What's the ongoing cost for the structure? Great question. It can depend. And the biggest difference here with those ongoing costs is really going to be how many entities do you have? That's the number one driving factor. The things that show up as ongoing costs here are typically, there's going to be an additional tax return for the C corporation. And then every year as you go through, I showed this picture earlier, there's this management fee and these management services that get provided. Okay, so the ongoing compliance component of this to make sure that you've got a good defense, and just in case you get selected in a random audit, what happens is there's a management fee analysis that's redone every year. And normally we offset the start date of the MSO. So the MSO may have a fiscal year that ends in June, the end of June, or that ends at the end of September. And we'll do that so that you can kind of pick, well, where are you going to go through and pay taxes for this profit? What do we need to update to move money off the balance sheet? So we want an opportunity for some planning that's not on a calendar year, so we get a difference from your existing S corporation. That management fee analysis is usually a few $1,000s a year. Okay, that can be done by a lot of accounting firms. There's a few teams that we've worked with and done hundreds and hundreds of these together. They always go through and they'll do those in like October and November, and we're able to make some planning decisions before Christmas time in terms of what that means for this year and what that means in future years. That component's a few $1,000s a year. And then that C corporation return also has to go through and get filed. So it's for the amount of tax savings where it works really well, the costs are pretty nominal. If you're marginal and it's like on the bubble, then that's one of those things where we just need to look at it together and see what would the potential tax savings be, and is it worth it? Sometimes the answer is no, and that's okay. But it's a good exercise to sort of run those traps and find out should you do it or should you not. Okay. Also got a question about the complexity of tax filing compared to an S corp. Certainly adds a component there with a C corporation, but accountants, enrolled agents, they're really well versed in filing these things. So as long as you've got a qualified tax professional filing, there's really not a lot to note there in terms of the tax filing complexity. There's just an additional set of conversations that's happening that probably isn't occurring in your world now, if I had to guess, because I just normally don't see it, where you're doing some concerted efforts around tax planning in the fourth quarter each year, instead of trying to see, well, this is what happened. Let me buy something, right? If the answer to reduce your taxes is go buy something, that's probably like in the long run, that's not a great answer. And we should be looking at better strategies. And we certainly don't want to be just finding out in February and March and April, oh, well, you got to write a check for, this many tens of thousands or hundreds of thousands to the IRS. That's what all of this is designed to go through and try to mitigate. Good questions. I saw a question about, do we have a recording? We have a recording, but it's for us only, unfortunately. What we will be doing is we're going to email out some additional dates as we go through, just waiting to get those firmed up. I've got some travel where I'm at some conferences, speaking at some conferences later this month. So trying to firm up exactly what those dates are going to be, but we're going to have these sessions going through a couple of times a month at least as we continue to go. And my invitation for you is, even better than waiting what's probably going to be 2 or 3 weeks to hop on a next discussion, I would love to answer your questions and give you kind of the private tour of what this is. Go ahead and scan that QR code and put a time on my calendar for a business owner strategy session, and we'll talk together, answer your questions, give you the private tour since you joined late. Great question. Last question that we just got in that I'll go through and answer here is, will this automatically trigger an audit? And the short answer is no, this won't automatically trigger an audit. These types of structures, as I mentioned at the very beginning, they've been used extensively in very large-scale businesses, right? Large-scale medical conglomerates will use these to avoid unauthorized corporate practice of medicine. You'll see these in private equity funded roll-ups of urgent cares, dental practices, medical offices. They're doing the same kind of things here for an asset protection reason and avoiding that corporate practice of medicine. But there's no audit trigger, right? They're going through and doing these things because it unlocks these key efficiencies around structural integrity, asset protection, the efficiency with after-tax purchases, debt repayments, and things like that are funding the opportunities. And then obviously that ability for some tax planning that otherwise wouldn't be happening in your world. And so with that, I think we're all set on questions. I'm going to go through and just leave this screen up here for a moment as I start the process of signing off. It's been a pleasure to be with all of y'all here today. I really look forward to the opportunity to speak with you guys and explore what's the possible impact of how this could work in your world. What's the possible progress that you and your family could make in keeping more of what you earn and really limiting how many days a week are you working for the IRS so that more of those days you're working for yourself and your family. So with that, I appreciate you all. I hope you all have a wonderful, wonderful day. and look forward to talking to you soon. Bye.